Real estate investment presentation. Home equity loan versus a HELOC. Get ready, because we're raising the stakes with real estate. Comparing a home equity loan and a home equity line of credit, referencing Investopedia, a place you can go to look up terminology that is investment related, continuing your research from there. We have the home equity loans and home equity lines of credits, or HELOCs, H-E-L-O-C, are loans that are secured by a borrower's home. So like with other loans that we've taken a look at, if it's going to be a home type of loan, typically secured by the home, therefore, if there is a default, the lender typically has recourse to then the home. A borrower can take out an equity loan or credit line if they have equity in their home. So if you got equity in the home, the idea then being, could you access that equity in some way, shape, or form, making it more liquid so that you can then use it for other purposes. Equity is the difference between what is owed on the mortgage loan and the home's current market value. So as you have the home, possibly taking a loan out in order to purchase the home, you have some portion of equity, typically being the down payment at that point in time. As you pay off the home, and hopefully as the home goes up in value, that difference, that equity in other words, between the value of the home and the loan could then hopefully increase. As that takes place, then you could think, well, is there some way I could get access possibly to that so that I can use it for other needs, for other spending needs? So in other words, if a borrower has paid down their mortgage loan to the point where the value of the home exceeds the outstanding loan balance, the borrower can borrow a percent of that difference or equity. So that's going to be the idea, to get kind of access to that equity. Typically, you can't get access to the equity up to the value of the home under general conditions, because the lender is going to want some safeguard in the event that the economy actually goes down, home value goes down. But to the extent that you have equity, you're more likely to be able to access it through one of these resources. So home equity loans give the borrower a lump sum up front for which to spend, and in return, they must make fixed payments over the life of the loan. So a home equity loan is kind of a straightforward kind of process, similar to the original loan set up when purchasing the home. You get that lump sum up front. You got those standard payments for the repayment. Home equity loans also have a fixed interest rate. So typically, when you're looking at a home equity loan, like a fixed rate loan, possibly on the purchase side, you typically have that rate fixed as well. Conversely, home equity lines of credits, or HELOC, are credit lines that allow a borrower to tap into as needed up to this certain preset credit limit. So on the other hand, you could say, hey, look, is it possible for me to tap into that equity when I need it, instead of basically taking the lump sum out at this point in time, paying the interest in on it? I would like to, in the event that I need it, have the capacity to tap into the equity fairly quickly without necessarily needing to do it and having it available to me. So the HELOCs have a variable interest rate, and the payments are not usually fixed. So home equity loan versus the HELOC, both home equity loans and equity lines of credit allow consumers to gain access to funds that can be used for various purposes, including consolidating debt and making home improvements. So oftentimes when you're looking at refinancing or consolidating your debt, you're looking at your financial type of situation. One of the things with financial planning that you might want to do is try to consolidate the debt. Oftentimes the debt that is secured by the home is a place that you can consolidate or think about doing so, because you might get a more favorable rate due to the collateral on it. You can consolidate there. You might actually get a tax benefit that you want to consider as well. So that would be a common type of thought process when you're doing financial planning. However, there are distinct differences between the home equity loans and equity lines of credit. So let's start off with the home equity loan. We'll go through this fairly quickly, and then we'll take a look and compare it to the HELOCs. So we're at the home equity loan. A home equity loan is a fixed term loan granted by a lender to a borrower based on the equity in their home. So it's going to be a loan based on the equity, the difference in the home value, and by having a difference or equity in the home, they have some more safeguard because they can put the home on as collateral, and then they have that security for the lender, which allows them hopefully to give more favorable terms. Home equity loans are often referred to as second mortgages. Borrowers apply for a set amount that they need, and if approved, receive that amount in a lump sum up front. So you're going to say, hey, this is what I want. I want to tap into this equity. This is how much I need at this point in time. And then you could set up basically a standardized kind of loan type of agreement in a similar way as possibly the original financing of the home. The home equity loan has a fixed interest rate and schedule of fixed payments for the term of the loan. A home equity loan is also called a home equity installment loan or equity loan. Loan collateral and terms. The equity in your home is used as collateral, which is why it's called a second mortgage and works similarly to a conventional fixed rate mortgage. So you have a similar kind of process with, in essence, the second mortgage with the collateral on the home. However, there needs to be enough equity in the home, meaning the first mortgage needs to be paid down by enough to qualify for the borrower via a home equity loan. So generally, if you're taking out the second loan, they don't have the primary interest in the event that there's default on the payments. And so they're going to want enough equity in the home so that if you were to default and they sold the home and then paid off the first loan, they would still have enough equity in the home to pay them off, possibly even if there's a decline in the market. So loan collateral and terms. The loan amount is based on several factors, including combined loan to value ratio or CLTV ratio. Typically, the loan amount can be 80 to 90% of the property's appraised value. So it really depends on the environment at that point in time as to how much you can basically borrow up to the value of the property. 80% is kind of a little bit more safer, obviously, to the lender because that gives them more cushion between the difference between the loan values for all your loan values versus the value of the home, so that if you defaulted, you could still pay it off even if, by taking the home and selling it, even if the value of the home went down. The closer you get to the loan being equal to the value of the home, the more risk the bank is taking on in the event that there's a decline in the housing market, because they're not going to be able to they'll be underwater possibly, meaning the value of the loan higher than the value of the property. So other factors that go into the lender's credit decision include whether the borrower has a good credit history, meaning they haven't been past due on their payments for other credit purposes, including the first mortgage loan. So obviously we're going to take into consideration the payment history and so on to get the best terms, in addition to having the necessary equity in the home. Lenders may check a borrower's credit score, which is a numerical representation of a borrower's credit worthiness. Payments and interest rates. A home equity loan's interest rate is fixed, meaning the rate doesn't change over the years typically. Also, the payments are fixed, equal amounts over the life of the loan. So typically it'll be set up kind of like a typical installment type of loan, fixed payments that will be applied out, fixed rate, the portion of the interest and the principal then changing over the life of the loan as the payments are fixed. A portion of each payment goes to interest and principal amount of the loan. Typically, the term of an equity loan term can be anywhere from 5 to 30 years, but the length of the term must be approved by the lender. Whatever the period, borrowers have stable, predictable monthly payments for the life of the loan. So advantages and disadvantages of home equity loans. A home equity loan can be a good way to convert the equity you've built up in your home into cash. That's going to be basically the idea. You're saying, hey, I've got assets. My balance sheet has a lot of assets in it over the liabilities possibly, but I can't access it because it's in the equity of the home. Can I convert it to something liquid that I can use? So that could be used for that, especially if you invest that cash in home renovations that increase the value of your home. Obviously, if you take the second loan out and you put it back into the home in some way, then you're kind of reinvesting, possibly building up the equity. So you're taking the equity out and then putting it back into the home. You also want to consider what kind of tax advantages you might have for the interest and what you would need to do and what kind of limitations might be there for that kind of benefit as well. Although not always, the interest rates for home equity loans are usually lower than other credit products such as personal loans and credit cards. So when you look at the financial planning, oftentimes one of the major goals is to consolidate the debt, reduce the debt if possible, then consolidate it. Oftentimes, if you have a home loan, they're going to want to consolidate it, or you might want to consolidate it in the home loan because it being secured often results in it having lower rates that will result from it. So advantages and disadvantages continued. Another benefit to home equity loans is that you can pay off the loan early and refinance the loan at a lower rate. So you want to make sure that you have the ability to pay it off early, but typically you do. If you've got that ability, that's nice, so that you can have the set payments where they are and possibly then be able to pay more off if needed to pay it off sooner. A refinancing is merely taking out a new loan, so you also possibly have the possibility of refinancing, just like with a loan that is a fixed loan. If the interest rates go up, then you're looking pretty good because now you have the lower payments. If the interest rates go down, then you might have the possibility of refinancing. So a refinancing is merely taking out a new loan, presumably at a lower interest rate than the existing loan, and using the funds to pay off the high rate loan. By refinancing at a lower rate, you can save on the monthly payments and pay off the loan sooner. However, borrowers would need to go through the credit approval process again, and there may be fees for booking the new loan. Obviously, you'll have closing costs and whatnot with financing, as we've talked about in the past. A disadvantage of home equity loans is that the home could be sold to satisfy the remaining debt if the loan is not paid off or goes into default or non-payment. So clearly the bank has collateral, the home, so in the event that you default on the loan, then they have that recourse. As a result, borrowers must be sure not to get overextended and borrow more than they can afford to pay back. So obviously you want to make sure that you're not borrowing too much, because if you can't pay back the loan, then your home is at risk, of course, with the default process. If the loan goes into default, the bank may foreclose on or take back the home to satisfy the debt. Also, if real estate values decrease, the market value of your house could decline and you could end up owing more than your home is worth. Now, again, they kind of safeguard against that, the financial institutions, by typically these days not giving as much loan as the value of the home, so that if there is a decline in the market, there still could possibly be a cushion. Now, if you can pay off the debt, it's not really a big problem, but it's kind of disheartening when you're in a situation where the loan value is higher than the home value. Should you want to relocate and the home decreases in value, you might end up losing money on the sale of the home or be unable to move. Home equity line of credit, or HELOC. So home equity line of credit, or HELOC, is a revolving credit line. So now we got the difference here on the HELOC, the credit line option. So a HELOC allows the borrower to take out money against the credit line up to a preset limit, make payments, and then take money out again. So it kind of works kind of like a credit card, right? You got that line of credit that you could take out, and then you could basically pay it back. With a home equity loan, the borrower receives the loan proceeds all at once. So with a loan, you don't have that option. You're saying, hey, I want this money now, and I'll agree to pay it back according to these terms. You can pay it back sooner, but you don't have that revolving credit. Like, I'm going to take money back and I'll pay it back when I pay it back, and then we'll charge me the interest as we go, kind of like a credit. So while a HELOC allows the borrower to tap into the line as needed. So the line of credit remains open until its term ends. Since the amount borrowed can change, the borrower's minimum payment can also change depending on the credit line's usage. So you don't have that same standardization. You don't have that amortization table that's just a standard fixed payment, fixed rate, and so on, because it's acting more like a credit card. The payment backs can change, and there's less conformity or the same. There's less the sameness, that's in a revolving line of credit. So loan collateral and terms, like an equity loan, home equity lines of credits, or the HELOC, are secured by the equity in your home. So same kind of scenario. If they're giving you a loan, if they're giving you money, whether it be in a fixed amount or in the form of a HELOC, kind of a line of credit type of situation, they are doing so with the approval or the consent or having collateral of the home. So although the HELOC shares similar characteristics to a credit card, since both are revolving credit lines, the HELOC is secured by an asset, your house, while the credit card are unsecured. So you might say, well, why don't I just use a credit card or something like that? That obviously the home loan is secured by the house. The HELOC is secured by the house. That might lead to more favorable rates, and it might lead to the ability to access cash that you might not get with the credit card. So typically, you'd get better rates with the HELOC, and it could be, more ability to access it given the amount of equity that you could have in the home. So in other words, if you stop paying your payments on the HELOC, called default, you could lose your home. So same kind of thing. If you stop paying the credit card, it's going to cause problems. It could cause you, they hit your credit score and whatnot and do collection action, but they don't have the exact recourse over something like the home in the way that, of course, if you have a HELOC, which is secured by the home, does. So the HELOC has a variable interest rate, meaning the rate can increase or decrease over the years. So this can be like an ARM that we've talked about in the past, can be beneficial or non-beneficial, but the interest rate will basically fluctuate over time with it. As a result, the minimum payment can increase as rates rise. However, some lenders offer a fixed rate of interest for home equity lines of credit. So you might have the fixed rate for the home equity line of credit option that you could look into. Also, the rate offered by the lender, just as with a home equity loan, depends on your creditworthiness and the amount you're borrowing. So obviously, again, other factors being involved, including and in addition to any equity that might be necessary for the bank in drawing up the terms for the HELOC. Draw and repayment periods. HELOC terms have two parts. The first is a draw period, while the second is a repayment period. The draw period, during which you can withdraw funds, might last 10 years, and the repayment period might last another 20 years, making the HELOC a 30-year loan. So you can imagine kind of different options here, but you got the periods here once again. The draw period during which you can withdraw funds might last 10 years, and the repayment period might last another 20 years, making the HELOC a 30-year loan. Once the draw period ends, you cannot borrow more money after the draw period. So draw and repayment periods. During the HELOC's draw period, you still have to make payments, which are typically interest only. So as you are drawing, if you're drawing money out, then you still got the payments, but it might be just the interest only, not paying back the principal, or not required to at least. As a result, the payments during the draw period tend to be small. However, the payments become substantially higher in the repayment period, since the principal amount borrowed is now included in the payment schedule along with interest. So once you get into the payment period, then they're going to say now you need to start paying back not only the interest, but you got to pay back the principal, paying back the actual loan itself, not just the rent on the money, the interest, and therefore, of course, the payments would be higher at that point in time to pay down the loan in that last scenario for the last kind of 20 years on the payback period. So it's important to note that the transition from interest-only payments to full principal and interest payments can be quick and a shock. Borrowers need to budget for the increased monthly payment. So clearly this is a situation where, you got like kind of an uneven situation if you're using the funds, pulling out the equity in the credit line, in essence, in the HELOC on the early years. You got to make sure that you're ready, prepared for the fact that at some point you're not going to be able to borrow the money anymore, and the payments are going to go up because you're going to have to pay back not only the interest but the principal. Advantages and disadvantages of home equity lines of credit. With a HELOC, you know that the maximum you can potentially borrow, which is the amount of the credit limit. So you know kind of your limit there. Also, HELOCs offer flexibility to borrow as much or as little as you need up to the credit limit. So that's kind of one of the major advantages you would think for many people. If they're saying, I want access to the equity in the event of an emergency or something like that, but possibly not taking the money out directly right now because maybe I don't need it right now, but I want to have the ability to access it in the event that I do need it, as kind of like an insurance plan or something like that. That's one option you might use it for. However, a disadvantage to HELOCs is that the interest rate can rise, and so too the payments as a result. So if you have the flexible rates, that can increase the rates. This uncertainty can make it difficult to determine the overall cost of a HELOC. So clearly, if you don't know exactly what your needs are in the future, you don't know how much you're going to take out, you don't know what's going to happen with regards to the interest rates, then it's really hard to kind of there's a lot of uncertainty in that scenario. That's the point. At the same time, the fact that you have uncertainty and want access to the HELOC in case you need it in the event of an emergency is part of the reason you might have it, but it also makes it difficult to exactly plan what's going to happen with regards to it. So advantages and disadvantages continued. However, if a HELOC has been borrowed from, the amount outstanding can be refinanced into a fixed rate home equity loan. So if you have stuff outstanding on the HELOC and you're saying, hey, I'd like to refinance it in a similar way as you might refinance a fixed loan when the rates go down, if say you just want to have a more standard loan to fix the rate or something like that, you may be able at some point to take the HELOC once things become more stable and say, let's just convert this back into a fixed rate loan. The lender would issue the new loan and use the proceeds to pay off the HELOC, in which the credit line would be closed. The borrower would pay back the funds under the home equity loan. Of course, the borrower would need to go through the credit approval process to swap the HELOC balance into a fixed rate equity loan, and there's no guarantee of approval. So the key difference is then, HELOCs can be used as an equity improvement loan since they allow you the flexibility to borrow as much or as little as you need. So the HELOC gives you that flexibility. If it turns out that you need more money, you can get it from your line of credit, assuming there's still availability, without having to reapply for another mortgage loan. That's going to be some of the benefits of the HELOC, that flexibility to pull the money out if needed up to a certain limit. Key differences continued. One question you should ask yourself, what's the purpose of the loan? Meaning, what am I using the loan for? Do I need a HELOC or do I need a loan? Do I need the money right now? Is the money necessary? Am I building a project onto my house, or am I consolidating debt where I need the funds at this point in time? Can I determine exactly what those funds are and therefore have a fixed amount, or is there uncertainty? So a home equity loan is a good choice if you know exactly how much you need to borrow and how the money will be used. So obviously, the more clear your future plans are and how much money you feel you actually need and how confident you are with it, the more likely it would be best just to plan exactly for what you need and take out the standard loan rather than the line of credit. Once approved, you're guaranteed a certain amount, which you receive in full when the loan is advanced. As a result, home equity loans can help with big expenses such as paying the children's college funds, remodeling, or debt consolidation. So if you got a big project, you're building on the home, you're paying for the college, and this and that, you know what the payments are and whatnot, you know how much money you need, then you would think the standard loan would be best under those conditions. Conversely, a HELOC is a good choice if you aren't sure how much you'll need to borrow or when you need it. So that's one of the key benefits of the HELOC, is you're saying, there could be an emergency. I don't have any money because all my money is stuck in the home. It's stuck in the equity. I have no liquidity. If there was an emergency, then at that point in time, it might be more difficult for me to access the funds at that point. I might not be able to turn it around as quickly as I would like. Therefore, I would like to have access to a line of credit supported by the home so I can access in that event. So the uncertainty itself is the benefit of why you might want a line of credit. So generally, it gives you ongoing access to cash for a set period, sometimes up to 10 years. You can borrow against your line, repay it all or in part, and then borrow that money again later, as long as you're still in the HELOC's draw period. However, an equity line of credit is revocable, just like a credit card. If your financial situation worsens or your home's market value declines, your lender could decide to lower your credit line or close it altogether. So if you're saying, hey, I'm doing this in order to kind of support myself in the event of the emergency, if the emergency happens to be that the home market goes down and your house goes lower than the equity line, and you're defaulting on your loans and what your credit worthiness goes down and whatnot, then that could, of course, make the lender, feel that you might not have access then to the HELOC as well. So got to take that into consideration. So while the idea behind a HELOC is that you can draw upon the funds as you need them, your ability to access that money isn't a sure thing. So the references, remember, we're referencing Investopedia. Investopedia, a place you can go to look up investment-related terminology, continue your research from there.